It really comes down to a few simple things. It comes down to how much you will spend and how much you will receive as a result. Now, obviously, there's other benefits to take into consideration, such as appreciation, tax, and all of that, and we'll talk about those things. So again, it comes down to how much you will spend and how much you will receive back. So, what are those expenses and how and when you will receive that money back? That depends on the type of project, and we'll break down some types of real estate projects, whether it's a flip or a rental in this video. So, first, let's talk about a flip, right? How do you evaluate a flip? Then we'll talk about evaluating rentals. So, when you're looking at a flip, the first thing you want to look at is how much will this house be worth, right, when it's all said and done. Some people call that the ARV, the after repair value. So, how much will the house be worth after it's repaired? Okay. From there, you want to then subtract your purchase price or purchase costs all in. And what do I mean by that is the price of the house plus your closing costs and any of the other fees that are going to go into your upfront costs, right? So you usually have your purchase cost plus your closing costs on top of that. Okay. Then you want to look at your rehab costs. How much money will it cost to rehab or remodel this house or this property? Then you want to look at your holding costs and be sure not to overlook that. Holding costs are things that you pay as the property is getting the work on. So, for example, taxes, insurance, loan payments, utility bills, basically anything you're going to have to pay while maintaining ownership of this property. And then you want to also look at selling costs. When you sell this property, what costs are going to be there? You're usually going to pay commissions, right? You're usually going to pay transfer tax. You're going to pay any seller assist or concessions, recording fees, and paying off any loans or bills that are owed on the property. So again, for a flip, you want to take a look at the after repair value minus the purchase price all in, including closing costs, minus rehab costs, minus holding costs, minus selling costs, and then that is what you're left with. That is your profit. So do the numbers and see if the numbers will work, and if everything goes well, will it return a profit that meets your goal or not? Unfortunately, so many people begin a flip project and end up barely breaking even or sometimes even losing some money in the process. So, how do you look at a rental? As far as a rental, you want to look at first how much it brings in per year, so your gross operating income. And then you want to take a look at your expenses. And expenses don't count your mortgage here. We'll take a look at your mortgage in another category. So your expenses are any fixed costs or any variable costs that you have. So fixed expenses are going to be things like your tax, your insurance, your management fee, security, anything like that. And also utilities that the landlord, you, the owner, are responsible for. And your variable expenses are going to be things like snow removal, lawn maintenance, repairs, things like that. Once you know your gross operating income, how much money comes into this property from rent and from other income, then you want to subtract the expenses, and that will leave you with your net operating income, which is essentially how much the business nets, right, before you have to pay off the loan, and you call that debt services. Okay, so you have your gross operating income minus your expenses. That will give you your net operating income. Then you want to subtract your debt service, and your debt service are your principal and interest payments that you make on your loan. Okay, and then that will give you the cash flow, essentially the money that should be sitting in the bank after it's all said and done. So, real quick, again, with the rental, you want to look at the gross operating income, subtract your expenses, that will give you your net operating income. Then you want to subtract your debt service, which is your principal and interest payment, and that will give you the cash flow, which is essentially your profit. Now, between long-term rental, short-term rental, and mid-term rental, you're going to have some differences. The type of expenses are going to be different. For example, a short-term rental, you're going to have cleaning expenses where you don't have that in a long-term rental. Also, in long-term rentals, sometimes the tenants are responsible for some of your utilities. In short-term, the owner, you are responsible for all the utilities. Now, other things you want to take into consideration before you invest in a property is appreciation. Basically, how much will the property value grow over time? and also the tax benefits, basically the tax deductions that you're going to receive because of the expenses you're going to have on the property, and also the depreciation. So depreciation in very short term is really a fictitious loss for tax purposes. You're showing that the property is experiencing wear and tear, and therefore you're taking financial loss on the worth of that property, and that's money that's going to come off your net income that you get taxed on. I'll discuss the differences between long-term, short-term, and mid-term rentals in another video, so be sure to look out for that. Hopefully you found this helpful. I look forward to bringing you more great content and teaching you about real estate. Subscribe to my channel if you haven't already.